Chapter 2 will be a review of the accounting process. So here we have our basic model. Whoops, sorry, too far. The basic model. So basically what that's saying is that something happens in the business, like an economic event that's going to change the financial position of that company, and we're going to need to record it, and we'll record it doing journal entries. So external events, we could be paying somebody else. Internal events, if we're just moving something from one department to another, that is not going to involve our financial statements. So our accounting equation is our assets are equal to our liabilities plus our owner's equity. And then remember what those are. The assets are something that we own. The liabilities are something that we owe. And then the equity is what our investors have invested into the company and that the company is retaining. So they list that both liabilities and equity are claims because, again, the shareholders have invested their money into the business, but again, they're part owners and they would hopefully like to get some money back for their investment. So we go through some different examples. So if the attorney invests $50,000 into his business to open it, we're going to increase our assets in the form of cash and then increase our shareholders' equity, again, because he's the owner. What if we borrow money? Our assets are going to increase again in the form of cash. And now it isn't an investor, it is a bank or someone who we owe the money to. So it's a liability. But again, notice that, again, everything's equal. So that's kind of the moral of going through these. You see that the accounting equation always stays equal no matter what the transaction is. So we purchase supplies, and when they say it's on account, it means we didn't pay cash for them. They send us an invoice, we owe it. So that account is called accounts payable. So assets goes up now in the form of supplies, and liabilities go up in the form of that accounts payable. We perform services, and now we are a service provider, so that's how we make our money. So revenue is going to increase, and revenue rolls into our equity through retained earnings over time. And then we build out our customer, and when we bill out a customer on account, it is called an accounts receivable. So assets go up in the form of that accounts receivable, equity goes up in the form of the revenue. Now we have expenses. So we pay our employees. So cash goes down, assets go down, and then now our expenses go up. But again, think of what's in this shareholders' equity. Basically, what happens is our net income will roll into retained earnings, which is a part of our equity, but net income is revenues less expense. So if we have additional expenses, it reduces our equity. Same with the utilities. Now we did not pay them, so our accounts payable, our liabilities go up, and then our expenses goes up, which reduces, again, the net income, which will ultimately reduce retained earnings and stockholders' equity. Then when we make a payment, we pay somebody that we owe. Our cash is going to go down because we're making the payments, and then our liabilities are going to go down because we no longer owe them. We paid them. And then, so this kind of talks about what I was referring to as we went through those slides, this retained earnings. So retained earnings rolls into our equity section of our balance sheet and of our accounting equation. And what goes into retained earnings is our revenues, less our expenses, and then less any dividends we would pay to the stockholders at the end of the year. So again, that helps you to kind of understand when you go through some of those details. Then we always have double entry accounting. So anytime you're doing a journal entry, you're going to have a debit and you're going to have a credit. And then you want to understand that those impact the accounting equation, and the accounting equation should always be equal. Our accounts are what we use in those journal entries. Then those accounts are going to roll into the general ledger. I like to say really they'll roll first into the T accounts, and then the T accounts we will total, and then that rolls into the general ledger. So here shows you a T account. So again, we have whatever account name it is. So let's say it's cash. If we debit cash, it's going to go on the left side of the T account. If we were to credit cash, it would go on the right side of the T account. And then these are rules, and you may want to jot these down if you don't already kind of have them to memory. But our assets, our expenses, losses, and dividends increase with a debit. They decrease with a credit. Then the reverse is true of our liabilities, our equity, revenues, and gains. Those will decrease with a debit and then increase with a credit. So again, that, like, I would definitely, if you don't already know those by heart, jot those down and have those in front of you anytime you're doing your journal entries. So here's a couple examples, again, of the same kind of similar thing that we're doing, but now they're going to trace it through to the T accounts. So not only the accounting equation, but into the T account. So here, when we borrowed the $40,000 from the bank, cash came in, so we increased cash with the debit. And again, notice they have that right under the assets. Then liabilities increased, and then notice we increased that with a credit. And then again, the accounting equation, those still balances. And then here's again those same rules, but kind of set up in the T account form, listed, in the same setup as our accounting equation. So that might be another slide to go back to and kind of look over. Then as they post into our accounts, we'll have permanent accounts. So those are ones that are on the balance sheet. So our assets, our liabilities, and our shareholders' equity. And again, because think about what those are. Those are assets, which are things that we own, liabilities that are things that we owe, and then what our stockholders have invested in the company. So just because we get to the end of the year, our cash doesn't go down to zero. Our liabilities don't go down to zero. If we have a bank loan, we still owe them. Our shareholders, we don't give them their money back. So those continue on year after year. It doesn't matter. The temporary accounts are all like our income and our expenses, gains and losses, and then also dividends. And then those are zeroed out at the end of the year. So each year we start fresh. We have zero revenues on January 1st, and we start a whole new year. It enables us to compare one period to another. So here is our accounting cycle in total. So we have documents that come in that, so we get an invoice in, we analyze that invoice, and we record it into a journal entry. And then we post that journal entry into our general ledger accounts. And then we total up all the transactions for the period, and then we'll create a trial balance. Then at the end of the month, we'll go through and say, do we have any adjusting entries that we need to make? Things that have happened, but we didn't pay for them yet or get the cash yet, or different journal entries that we need to make to allocate, like depreciation expense and things like that. Those are all adjusting entries. Then we'll prepare our adjusted trial balance. And then from that adjusted trial balance, we will prepare our financial statements. Hold on just a second here. Okay. Then once we prepare the financial statements then and everything is done and those are completed, we will close all of our temporary accounts. So like I said, those are all the items that are on the income statement. Those will get closed. So here they explain to you the different types of source documents that we could have. We could have sales invoices, invoices from our suppliers, cash receipts that come in. So all those things are going to be accounting documents that we need to record. Then we're going to analyze those documents so that we understand what accounts we need to post them to. So again, going back to those first examples, the attorney invested $50,000 to open the law firm. So we know it's assets and equity. We're going to debit cash, and then we're going to credit shareholders' equity. Then that bank loan, now we're going to debit our cash for $40,000, And then we're going to credit the notes payable because we now owe the bank for $40,000. But notice how the accounting equation grows and we are still equal. Then we purchase supplies on account. So our assets go up in the form of a debit to supplies. Our liabilities go up in the form of a credit to accounts payable. And then notice our accounting equation again still balances. Now we perform services, so that's revenue. They were on account, so it goes to accounts receivable. That's our debit. And then our credit is to revenue, which again goes into equity. And again, you can see the accounting equation is still in balance. We paid those $5,000 of wages to employees, so we're going to credit cash, and then we debit salaries expense, and now our assets are reduced and our owner's equity is reduced. But again, notice in total, that accounting equation still balances. And then you can notice on that T account, cash has multiple transactions to it. Now we have $500 of utilities incurred but not paid, so we have expenses as our debit, and then we credit accounts payable. And again, you can see accounts payable has multiple transactions, so we would be continuing to build that balance. Then $1,000 are paid on account to the supplies vendor. So then we're going to credit cash when we pay it, and we're going to reduce that accounts payable that we owe. So again, now you notice that we haven't paid them all off, but we've reduced that balance by the $1,000. And then finally, the accounting equation is in balance. And then when we record it into our journal, so the general journal is where all the journal entries are posted. You can have special journals like a sales journal, maybe or a cash journal, where you can go down into more detail and more of like a subsidiary type of a ledger. And if you worked in those departments, you would have those. So again, here it shows you some of the same examples we went through, but actually just showing the journal entry by itself without going into those T accounts. But the debit is always the account you list first. Now remember that, because in the homework, it will score you wrong if you try to put the credit first. So the debit account goes first. We debit cash $40,000, credit notes payable $40,000. And then here are all of the transactions for this particular month. So again, we have a variety of things that they're going to record. So they invested $30,000 in cash and they received shares of stock. So the journal entry is to debit cash and then credit common stock for the $60,000 because there was 2 people who invested. And then that $40,000 notes payable, again, cash comes in as the debit. We credit the notes payable as our credit for $40,000. Now we have a prepaid rent. So this is the first we've had those. So we pay $24,000 in advance for 1 year's rent. So we don't charge that all to rent expense because it's going to last for a whole year. So we debit prepaid rent for $24,000 and then we pay for it, so we credit cash. We'll see when we get to the adjusting entries, we will deal with that later on. We purchased office equipment for $12,000 for cash, so we debit office equipment and credit cash. We purchase inventory, so we debit that for $60,000. Now this is on account, so we credit accounts payable. So anytime we owe on account, it's accounts payable. Anytime a customer owes us on account, it's accounts receivable. If we're using the perpetual inventory system, we have inventory and cost of goods sold that are consistent, that are continuously being updated, like through barcodes and scanning. So we're immediately scanning stuff in, scanning stuff out, so we know what's happening in our inventory all the time. If we use the periodic inventory system, things get charged to inventory as we purchase them. Then at the end of the month, we look to say, okay, how much do we have left in our ending inventory? And then the rest must have been sold out to cost of goods sold. Then here's our purchase of supplies for cash. So we debit supplies, credit cash. Now here we sold merchandise costing $20,000 for $35,000 cash. So remember that we will have a double entry when we sell product. So cash, the first entry deals with the sale. Cash comes in. We record sales revenue for $35,000. Whoops, sorry, let me go back. Then the second entry is going to be to charge out the cost of goods sold. How much did it cost us for that sale? And then take it out of our inventory and credit the inventory. Again, because the goods are gone and they're sold. Then again, here's another one. If we sold it for $3,500 now on account, so we debit accounts receivable for $3,500, credit sales revenue, so that records the sale. Then the second journal entry, we're going to debit the cost of goods sold for the cost of that clothing, and then credit our inventory because we want to take it out of our inventory because it is sold. Then now in this case, we're going the other way. We receive rent that's paid in advance. So we had one where we paid it. Now we're receiving it. So cash comes in, but it's in advance. We haven't earned it yet. So we put it into like an unearned revenue, a deferred rent revenue, and that will be a liability on our balance sheet until the time has passed and we've actually earned it. We purchased $25,000 of clothing. Oh, sorry, no, we paid it. We paid the $25,000 of clothing that was on an account. So we debit our accounts payable and then we credit cash. So we're reducing our liability. We paid our salaries, so we debit salaries expense and we credit cash. We receive cash on account. So we've already recorded the sale. It's in this accounts receivable. So now the cash comes in. So we debit that for $1,500 and then we reduce the accounts receivable for $1,500. And then we pay dividends. So we debit dividends and we credit cash. And then here it shows you kind of how it posts in. So it shows you the journal entry and then how it posts into the different T accounts. So it gives you the one example. We paid the prepaid rent. So it goes into the prepaid rent T account. And then we credited cash. And then notice all the transactions here, though, for this month of July in cash. There's quite a few. And then when we get down to the end, notice how we total it. So we add all of our debits for cash. We subtract all of our credits. And that leaves us an ending balance. And then notice we put it on the left because it is a debit balance. Now this one only has the one transaction, but that too is a debit balance, and that would be on the left. Then we do that for all of the accounts that we have that we used in the month of July, and then we carry out those balances. So the ones, again, that had multiple transactions, you always just want to net those. So like looking down here at accounts payable, we had a $60,000 credit, an increase to accounts payable. We reduced it by a $25,000 payment, so that leaves a $35,000 liability at the end of the month. So we always want to net all those out and figure out what the balances are. And then once we have them there, so then this is showing you the income statement accounts. So same scenario, though. We add them together to get to what our total is for that month of July. Then once we have them all in there, we prepare our unadjusted trial balance. So we list out all those accounts and their balance at the end of the month. And again, it's a trial balance. So the balance means what we have here in the orange, our debits need to equal our credits. If they do not, then we've done something wrong. So here shows you an example. And again, they go in order of the accounts. These are normally numbered so that you know what number to put them in, but they basically go in the same like accounting equation setup. So our assets, our liabilities, then our stockholders' equity, and then our revenues and our expenses and our dividends. So they go in that same basic order. Okay, then after we prepare that unadjusted trial balance, we look through and say, what adjusting entries do we need to make so that our financial statements are as accurate as possible. So we want to ensure that all of our revenues are recognized if we've performed the services, and that all of the expenses are recognized if we've incurred those expenses. So these are the types of adjusting entries that are made. We adjust those prepaid accounts, which could be, again, the prepaid expenses, or if it's the other way that people prepaid us, it could be deferred revenues or unearned revenues. Then we accrue any expenses or revenues that we have not paid yet. So they would go to accrued liabilities if we owe them, accrued receivables if people owe us. And then our estimates are like our depreciation. We're going to charge that off to expense as time goes on. So that kind of just lists out those different examples. So then here, of the prepaid expenses, when we do our adjusting entry, remember it was like in prepaid rent. Well, we're going to reduce it. We're going to take it out of the prepaid rent, and we're going to charge off to rent expense. So we're reducing our asset on our balance sheet and then increasing our expense on our income statement. So here is what if we had supplies and we used some of them up. So we purchased $2,000 of supplies. At the end of the month, all that's left is $1,200. We must have used the difference. We must have used up $800. If we used it up, we need to charge it off to expense and take it out of our supplies account, which is an asset. So then there you can see it go into the T accounts. And then again, the same with that prepaid rent. If it was for a whole year, that's $2,000 a month. So we're going to debit rent expense and we're going to credit prepaid rent. And then you're going to see it comes out of the prepaid rent account to reduce that balance down to the $22,000 and then charge it off to rent expense. And then depreciation are those estimates. So if we had office equipment for $12,000 that we are depreciating out over 60 months, and we're going to depreciate it over the whole, all the way down to zero, that's going to be $200 a month. So we debit depreciation expense for that $200, and then we credit accumulated depreciation. So we always keep that depreciation expense in a separate account, so we maintain our historical cost. Then those deferred or unearned revenues, when we do earn them, we're going to take them out of our liability and put them into revenues. So we will decrease the liability and increase our revenues. So then here it is. If we've earned $250 of that rent paid in advance, we're going to debit the deferred rent revenue and then credit rent revenue. So then you see when those post in, we still have a balance in that deferred rent, but we've earned some of it. Then our accruals, again, it either could be we're accruing expenses or we're accruing revenues. So if it's a liability, it's an expense. We're going to debit whatever expense it's for, and we're going to credit a liability relating to that expense. So it's going to increase our expenses and then increase our liabilities. So salaries are the best example because normally we always are paying our workers, and rarely does a month end exactly on the last day of the month or a pay period end on the last day of the month. So if we have $5,500 of salaries that we need to record in July, we're going to debit salaries expense and then credit salaries payable. And then when we pay it, we would pay it out of that salaries payable. Interest is another one that we need to accrue because many times we don't pay it until the note is due or maybe at the end of the quarter or the end of the year. So we want to record the interest expense as it's incurred. So that'd be 1 month at a time. So we have a $40,000 loan at 10% for 1 month out of 12. That's $333 in interest each month. So each month we're going to do this journal entry, debit interest expense for $333 and then credit interest payable for $333. And then if it's revenue that we have earned but we have not billed our customer yet, we're going to put it into an accrued receivable and we're going to credit the revenue. So revenues go up and assets go up. Interest is another one that could go the other direction. So our customers could owe us and we're charging them interest. So if they owe us $30,000 and we are charging them an 8% rate, we want to calculate that out monthly. So divide it by 12, that's $200 a month. So we'll put that into an interest receivable this time because our customer owes us, and then we'll credit interest revenue. And so we already did an example of depreciation expense. Another example of estimates is the bad debt expense, where then we're estimating what that is and doing an adjusting entry for that. Sorry, I keep hitting the wrong button. So then we've got our adjusted trial balance then is after all those adjusting entries have been recorded. Then we add those into the unadjusted trial balance to create the adjusted trial balance. So then here you can see the unadjusted, and then here's the adjusted. So notice we have accounts that we didn't have on the unadjusted. So we have accumulated depreciation, we have interest payable, we have the rent revenue that we didn't have, we have supplies expense, rent expense, depreciation expense, interest expense. So there's a lot of things that we added in those adjusting entries. But then notice it does still balance. Then we take that adjusted trial balance and we prepare our financial statements. So our income statement, our statement of comprehensive income, our balance sheet, our statement of cash flows. So we'll go through those. So it's always good if you don't understand these, like look back at these examples. But our income statement is our revenue. Then if we are selling product, it's going to be less our cost of goods sold to provide us a gross profit. Subtract all of our operating expenses, and that provides us with operating income. And then our rent or our interest revenue and our interest expenses and our rent revenue, if we're a product seller, would be down here in other income. And then we would total that out for our total net income. Now then our total net income is going to go into our statement of retained earnings. That's always one of the items that funnels through here. This statement of comprehensive income, this is when we get into more complex accounting topics. There's certain topics that will get posted in here. So they won't go into our income statement, but they'll go into the statement of comprehensive income. So again, it's a little higher level of an accounting topic. Then our balance sheet is our assets and our liabilities and our equity. So now we'll break them out though into kind of a classified balance sheet. So we're going to say what are current assets versus our plant assets, our current liabilities versus long-term liabilities. So current assets are things that will be converted into cash within 1 year, and current liabilities are liabilities that will be paid within 1 year. Then our non-current assets are going to be like our property, plant, and equipment. If we had any long-term investments or even intangible type assets, those would be non-current. And then our long-term liabilities are anything that's going to get paid over a year. And then our shareholders' equity would be our common stock, paid-in capital, and then our retained earnings. So again, here's an example, and it is classified in that we list our current assets and we total those up, property, plant, and equipment, total those up, add those together to get to total assets, current liabilities plus our long-term liabilities, and then again, all listed out separately, and then our common stock and our retained earnings. The statement of cash flow is a little bit more challenging, and we will have 3 sections. So we'll have our operating activities, our investing activities, and our financing activities. And the operating activities include anything that relates to our day-to-day operations, including changes in our current assets and our current liabilities. Our investing activities all deal with those non-current assets, whether we buy some or sell some. And then our financing activities deal with our long-term debt and our equity, kind of how are we financing the transactions. So then here's an example that shows you cash coming in, cash going out. This is all dealing with our operating activities, then our investing activities, our financing activities, and then our total change in cash. And then our statement of stockholders' equity, like I said, when we did our income statement, that net income will roll right over into that statement of retained earnings, statement of stockholders' equity. So you'll see that coming in the retained earnings section. We issued common stock, so that's in the common stock section. We pay out dividends, which is in the retained earnings section. And then that will equal our total stockholders' equity. And then that should tie back to our balance sheet. Then one of our final steps is to close out those temporary accounts. So like I said, the temporary accounts are all the items on the income statement as well as our dividends. And those we will close out, and they eventually get closed into retained earnings. So we debit the sales revenue and the rent revenue to take it off of our books to bring it down to zero. We credit the retained earnings. We close out all the expenses. So we credit the cost of goods sold. All of those expenses will be credited because we're taking those down to zero. And then we debit the retained earnings. So again, the net of those revenues and those expenses are our net income. And that's how that closes into retained earnings. And then our dividends are basically paid out of that net income. But again, the net income is already closed into retained earnings. So we debit retained earnings and then we credit the dividends to close those out. So here again shows you it kind of as a T account. So we have whatever our beginning balances is, plus our revenues, less our expenses, which again, those two lines would basically be our net income. And then less our dividends paid, and that leaves us our ending balance. And the ending balance is the income that the company is going to retain or keep. Then we prepare our post-closing trial balance, which, as you notice, is all those balance sheet accounts. So you don't see any revenues, you don't see any expenses. It is just the balance sheet and then the new retained earnings after we've closed out those accounts. Now, you sometimes have to worry about this concept here when you're preparing your statement of cash flow, because if we're trying to go on the statement of cash flows from accrual-based accounting to cash-based accounting, because we want to know how did the cash flow. If we have an increase in any of our assets, that is going to be a that's going to, so this is going the opposite direction. No, we're going from cash to accrual. So I was going to say, because it's the reverse if we're going the other way. So if we're going from cash to accrual, if we increase our assets, we're going to add that. If we decrease our assets, we would deduct it. If it was a liability that increased, we would deduct it. And if it was a liability that decreased, we would add it. So again, trying to go from a cash basis accounting to accrual based.